All right, we got SVB Financial Group, aka Silicon Valley Bank's 10K. This is the annual report that they're required as a publicly traded company to file, and this was audited by KPMG. And I'm sure if you're watching this video, you're very familiar of what happened this week with Silicon Valley Bank going out that was taken over by the government. So I'm not going to take that. I'm not going to look at this for the banking collapse angle. I mean, that's part of this, but I want to look at the held to maturity and available for sale investments they were holding on their balance sheet to get an idea of what happened with Silicon Valley Bank, and just get a good look at the different accounting methods. And I specifically want to look at available for sale and held to maturity investments. And I want to look at what Silicon Valley Bank was holding. So maybe that could give us a little bit of color, a little bit of context of what happened this week. So let's dive into it. So I did a quick search on available for sale, and on page 65, we got this nice little footnote on available for sale securities. And looking at this, Silicon Valley Bank had $26 billion of debt securities classified as available for sale securities. And as you start reading through the footnote, we get our first red flag that there might be trouble brewing within Silicon Valley Bank's investment portfolio, with this note of a $2.4 billion decrease in fair value of available for sale securities, the result of higher interest rates. And if you're not that familiar with bonds, basically, when you have a bond like a treasury bill, and let's say in the last 3 years, we've been in a very low interest rate environment. You bought $1 million bond and it's yielding 2%, and treasuries have jumped to 5%, and you need to sell that particular treasury that is yielding 2%, the equalizing factor is you reduce the bond value to offset the higher interest rate environment. And that is what's happening here. Their available for sale securities portfolio is yielding a whopping 1.5%. And as the Fed's been raising interest rates, you can get treasury bills at much higher interest rates, which means the carrying value of those debt securities is going to go down. And that is why you have this 2.4 billion with a B decrease in fair market value on their balance sheet. Now, you don't see that on their income statement because available for sale debt securities, you're going to adjust that through other comprehensive income, which is on the balance sheet in your equity section. The value has gone down. It's not like they're hiding anything. It's there. But if you're just plainly looking at the income statement, you might not realize that their investment portfolio has gone down by $2.4 billion. So let's jump down to held to maturity securities, which is going to have a different accounting treatment compared to available for sale. As the name indicates, held to maturity, you're going to hold these fixed income, these bonds, until they mature and you get your principal back. In that situation, the accounting treatment is you do not adjust those fixed income assets to fair market value. You just leave them at cost. And since you leave them at cost, this is where you can mask potential problems because you're not adjusting these bonds, these fixed income assets to fair market value. And if I'm an investor and I'm looking at the 10K, I'm assuming Silicon Valley Bank has $91 billion of held to maturity fixed income investments that are yielding about, on average, 1.66%, which is pretty low compared to what the Fed's been doing over the last year. So you got a situation, you got $91 billion of assets with the intention of holding them until they mature. However, Silicon Valley Bank found themselves in a bank run situation, and customers started withdrawing cash. They didn't have enough cash to support the withdrawals, so they had to start selling assets. And this is where your held to maturity investments incurred losses, realized losses. And those realized losses, when they had to sell those assets that they were at least on the financials, were intending to hold into maturity, this really exposed that their balance sheet just was not as solid as it looked when you're looking at the financial statements, because those held to maturity investments were not worth $91 billion. I don't know exactly what they were worth, but they were not worth $91 billion. And to dovetail off of that, this is where the FASB might want to take a look at held to maturity accounting policies and see if that makes sense to change. Maybe you need to go full fair market value for all investments that you're holding, even if you intend to hold it until it matures. Because this is a situation where a bank got exposed. They had a bank run. They had investments that were not worth what their balance sheet says, and you ended up in a terrible mess where a bank that's been around since the 80s had to turn themselves over to the government. So that's a little snippet of Silicon Valley Bank's financials and the investments that they were holding, held to maturity and available for sale, and where some of the accounting policies might not make sense anymore, and they might want to be looked at. There were some red flags in the financials letting you know that their balance sheet just was not as strong as it might have indicated. But there's going to be lessons to learn from this, and I'm sure there's going to be more to the story. This is the only reason that this bank went belly up. But hope this was helpful. I do have videos on held to maturity and available for sale securities if you want to learn the more dirty details related to those accounting policies. I'll link them in the description. Hope you have a good rest of the day. Take care. Goodbye.